Good morning, ladies and gentlemen. Well, according to my calculations, we are pretty neutral on the risk dial. I will go through what has happened and what is likely to happen and where the danger lies. But the good news is that finally we have found out what is wrong with it, and I have a quote which I've paid, and the estimated time is 4 to 6 weeks to have it all fixed. So hopefully sometime during the third quarter we'll have it all ready, or early in the fourth. And yes, without further ado, let's have a look at what the bonds are saying, because it's very, very interesting, and I will show you where the danger lies. This is the 2s 10s, and it's doing absolutely nothing. The danger is not in the 2s 10s. The danger is even not in the US. But what the 2s 10s basically faffing around this -30, -40 area tells me is that the 2s 10s butterfly is stable. The 2s 5s 10s butterfly, the 2s 10s part of it is stable, so the danger is in the 5s. If you have a look actually what happened to the 2s in yesterday's session on Friday, well, absolutely nothing happened to the 2s. The 2s are now stable. The danger is naturally that it goes and breaks above the previous high, which is here at 345, but it will be a parallel shift with the 10s, I believe. I'll show you that in a moment. So the danger is really not even in the 2s at the moment or the 10s, it's in the 5s, and it's not so much in the US as it is in Europe. The rest of the yield curve, well, 5s 30s, let's have a look at a weekly chart. To me, this level is the red line that I've marked at about 11, 12 basis points negative is extremely, extremely important. Keep an eye out of it as I go back in time. There's the red line, and every time it goes through the red line, it goes 30, 40, 50 basis points to levels such as 41 negative to 57 negative. And this, as you can see, is back in 2000 when the Fed was hiking. That is the kind of ultimate level that I can see happening in the 5s 30s. And if we go into the 5s 10s, have a look at this red line, we're above it. We go back in time, and this is the kind of level that I can see. I can see something like 32 basis point negative, so another 25 basis points on the 5s 10s. That is the area that is in danger. The 5s is the belly of the curve is the one that's in danger of blowing up. Here you have the yield curve. In green you have the prices from a month ago. In red you have the prices from a week ago, and in blue you have the yields from Friday. So you can see what is happening. The 2s are now at a level that is consistent with what Powell said. They are going to keep on increasing the Fed funds rate, most probably in 50 increments, unless we get data to make them hurry up, but it's going to be at least 50. So I don't think soft data is really going to move them very much. So the 2s are really not going to, or they shouldn't move very much from here unless you get acceleration in the inflation data and or unemployment data, which is unlikely until the meeting of was it September 20th or something. So what are we going to get until then? Nothing, because the price of oil hasn't really moved, and it's a backward looking indicator. So more or less we know that we are not going to get those accelerations. So where is the danger? The danger is in this part of the curve, that it flips positive or it goes flat. That is where the danger lies. To me, the danger is not so much in the 30s, in the T-bond and the 30s. You can see that the 30s really are moving very, very little. They've reached an equilibrium level, and they're really moving 5 basis points up or down. The danger is in the belly of the curve. And these are the fives, the belly. Could we go sideways for a bit? Yes, but I think at some stage over the next 2 or 3 months, you will get a bad piece of data which makes us retest this 359 level on the weeklies. And this 359 level, if I enlarge it, is you can see that once it goes through it, you get big moves, towards 460. So you get a whole percent move in the fives. The belly is the danger. Believe me, you don't want to be long of the belly. That's where the maximum pain could be. If we look at the tens, much more sedate. We're still within that 303 to 298 range, and I would have thought that this market is going to be stable for quite some time, just going sideways. And the 30s as well. The 30s had a good week. The only ones that were down on the week, still in this 322, 319 area. And when you think about it fundamentally, why would that be? Well, what has Powell said? Nothing new to anybody who's been listening to the Fed speakers for the past few weeks. He's saying higher for longer. Higher for longer means that the twos basically discount a Fed funds rate somewhere around 3.5, maybe slightly higher, and work out where the Fed funds rate are going to be over those 2 years, and what the break-evens are. The one that can really blow up, because it has the highest degree of uncertainty, is the the fives, because there you don't really know what to discount, whether you are discounting going up to 3.5 to 4% and then remaining stable, or going even further if the data says that it's warranted and inflation doesn't come back below 2%. Everyone knows that inflation is going to come back to the 3-4% range, but will it come back to 2, which is their target, or do they have to go even further? Well, if they need to go even further, the part of the curve that's going to blow up is the fives, and it's going to go positive to the twos, while the longer end is going to say yes, but the fact that they're doing that now means lower rates after the fives, and therefore the curve gets a kink. The twos stay relatively stable around 3.5 to 3.75, maybe 4%, but the fives go much higher than the twos, and then the fives and then the tens and the 30s will slope off, with probably the 30s as the lowest point in the curve. And Europe is where the real danger lies. Not because the real danger is that we completely lose credibility in the monetary policy of the ECB. When you have PPI in the 30s, and when you have energy prices doing what they're doing, the fear is that the market says monetary policy can't do it, and we completely lose faith in the fiscal ability of the Eurozone. And that means that there's a buyer strike, there's a bond buyer strike. That is the real danger. You know, listen to me, the real danger now is that we get a bond buyer strike in Europe. In which case, what happens? You get accelerations and maximum pain. This is a monthly chart of the Schatz. We are getting a monthly up. This move made absolutely zero sense to me. Played against it some, but now the danger is that we go all the way to first target 190s. Okay, and listen to me, this is not science fiction. I know that most people who have only traded since about here think that it's impossible for rates to go to the 190s. No, it's not. It can go a lot higher. 190 to me is quite conservative. If we have a look at the fives, this is another monthly chart of the fives. I think we can easily go to 2%, and then probably to close to 3%. This is just short of 3%. This is what, 288. These are the kind of moves that potentially you can get, not potentially, certainly can get if you get a buyer strike in Europe. The ECB to me has very little credibility. And if you have a look at what has been happening in the dollar, in the DXY, and the way Euro USD has been trading, continuing lower, even though the interest rate differentials are coming in against the US, that tells me that the probabilities of a buyer strike and completely losing faith in both monetary and fiscal policy in Europe, those odds are rising, and they're rising exponentially. To me, the danger in the next 6 months is that we have more than doubled the yields in Europe. If you look at the tens, this is the Bund. I would have thought this kind of test around the whatever that is, 206, is more likely than not. The yield curve, if people lose faith, they will lose faith in the shorter end, or that will be reflected much more in the shorter end than in the longer end, because they know that eventually they will address it. But to me, the bobble and the Schatz are just, games of pass the bomb. Because if you're holding them when it explodes, you're just going to be taken out. Volatility is likely to rise in these markets, and the moves are likely to be quite incredible. The French market, which technically trades the best, monthly up, to me, this kind of trading around 250 or touching 250 is almost assured. And then look at it. Look at these are monthly charts. Look where we could go. We could easily go to just below 340. So you can see how the real danger to me now is in Europe, that we completely lose faith in European ability to manage their affairs. We continue to have a weak euro and almost a doubling in yields in Europe. This is, to me, the most important chart, the differential between tens in Europe and tens in the US. Fundamentally, what has happened over the course of the past year? How to explain it best? the US has taken on the role of the inflation fighter, and Europe has been lagging. But the problem is in Europe, it's not so much in the US. Where are energy prices highest? Where is the danger of the war highest? In Europe, not in the US. And the US is doing all the right things. Powell told you that you can forget about any kind of pivot anytime soon. He will get inflation down to 2%. Well, how are the Europeans going to get inflation down to 2% with the euro being worth less than bog paper, and they're paying $1,600 a barrel equivalent for energy? It's just not going to happen. There's going to have to be a complete revolution in monetary policy, which I don't think is going to happen, not with Lagarde at the helm, or people are just going to give up on European ability to manage their fiscal affairs. If that happens, you get a buyer strike. End of story. Just a buyer strike. People won't buy at any level. And what happens then? Boom! You get this move straight down to 120 to 100 to 101. And if that happens, you are basically, you get why I just showed you those charts of the Bund and the Bobble and the Schatz, because then it's not the US that moves. It'll move in sympathy a little bit, but the 90% of the move will be in Europe. And if that happens, I can easily see the bond differentials coming into 50 even. Easily. So to me, this is the most important chart. If it closes any month below 153, 153 this level is, I think you get an acceleration, you get maybe a little bit of a pause around this 100, 107, and then it just falls apart and comes in all the way down to 50 basis points. This, to me, is the great big danger out there. Why am I so concerned about European yields? Well, because when a market like the Dixie and Euro USD stop responding to interest rate differentials, you know that there's a new game in town and that people are just losing confidence. I just showed you a chart where the interest rate differential in the tens fell by 30 basis points in a week. And the Euro USD went down. Now, you don't have to be a macro genius to understand that that is highly unusual, and that can only mean a loss of confidence in the currency. Why would there be a loss of confidence in the currency? Well, because there's a lack of confidence in monetary and fiscal policy. If the monetary policy can't catch up, then the fiscal policy has to take the strain. But if people say, no, the fiscal policy cannot take the strain, or if it does, we will just sell the currency. How does the fiscal policy take the strain? Well, what they could do is they could say, right, energy prices don't matter. We are going to fix the energy prices for the households, and basically we're just going to issue bonds for the difference, and the state is going to take the whole of the hit. Yeah, that's possible. You can insulate the population and take the difference between the prices paid and the prices sold into the fiscal realm, i.e. increase the budget deficits by a factor of X. But if that happens, the currency is going to get absolutely mullered. And what happens here every time that we go through 106, eventually we hit the 111 area, and then the 118 area, and then the 120 area. So to me, the 111 is almost given, and the question is, do we go to 118 to 120? That is, well, another 15% devaluation of the euro. And that is likely to happen in spite of their rates going absolutely berserk, higher, and catching up to the US rates. There you have it. That is what the market is telling you, is that the odds of a real buyer strike, i.e., I'm not buying the currency, I'm not buying the sovereign bonds, I'm not touching Europe, are increasing. And that means that you don't want to be short of volatility in any of those instruments. On the other hand, you want to be long of volatility there against short of volatility in the longer end of US. Because let's face it, people will buy something. And I think they'll be much more prepared to buy 30-year US at 330 than they're going to be prepared to buy 2s, 5s, 10s, Italy, France, Germany, in a currency which is going to depreciate 15% and where the yield is 160 basis points lower. How much lower can Euro USD go? Well, how long is a piece of string? This is going back to a weekly chart going back to the 2000s, which is exactly where you can match up those earlier charts of the European bonds. Last time they did something stupid. Well, first level 96.67 and then 88.47. If you get a buyer strike, these levels are absolutely sensible, okay? Because there just won't be a bid for the currency. And you can see how much volatility has to increase for us to reach those levels. The message from the market is, do not be short of volatility in anything with a euro sign on it. Gold, well, I just can't get bullish of it. It keeps on coming back to 1764. And why would I be bullish? Well, if I think there can be a buyer strike in Europe and that the euro goes to pot, then I'm thinking that the dollar has to be relatively strong. A strong dollar certainly doesn't make gold appreciate. And if there's going to be an accident in yields, that's going to diminish the attractiveness overall of gold, because it will make real yields in the world go higher. So I really don't see the point of being long gold. I think the odds that it breaks now and breaks definitively below 1710 are increasing, together with the odds of high volatility in anything with a euro sign on it. Gold might be stable to do better in euro terms, but in dollar terms, I just don't like it. And I haven't seen a single spread against bonds, against equities or anything, which tells me that that gold is going to be strong. On the, it might be stable relative to other asset classes, but it's not going to be strong. Therefore, I see absolutely no point in owning it at these levels. DBC, all it managed to do is basically touch my 26.93, and it's still in a consolidation phase. The fact that we've spent here the best part of 2 months and even longer tells me that the inflation numbers that are coming up are unlikely to be dreadful. And that is another reason why you shouldn't expect more than a 50 basis point move in September from the Fed. But that is the minimum you're going to get. It's the minimum and to me also probably the maximum. Why would this move? Well, for the time being, I don't see much reason. Gold DBC, it's stable at my level. If there is another kind of move in oil, is the only reason why you'd expect this to move. But I favor more consolidation before another retest of the highs. Maybe I'm being a bit of a pig, but I just don't see that it's that attractive a risk reward to be long of DBC here. I'd much rather be long of DBC at 28 than at 26.63. The reason why I can't see, that 26.93 level in DBC getting broken in a hurry is because all CL is doing is basically crawling along the 200-day moving average, trading, and it's probably likely to just keep on trading, in this kind of area between 85 something, and these higher levels which are around the 96, 97. It suits Biden that things stay in this range for a while. So until and unless I get a break of these ranges, I'm not going to be very excited about DBC. If I'm not excited about DBC, I can't be excited about what inflation is going to do, or what the figures of inflation are going to be for the next month, i.e. CPI and PCE and all that, because if this stuff is stable and they are backward looking, you're not going to get a spike in them, or the odds are very much lower, and therefore the long end of the bonds are going to be stable. The danger is going to be a blow up in the belly of the curve, and the danger is in the dollar going, which is actually deflationary for the US, right? So why should oil go up? Nothing that I can see, and my whole narrative to you today suggests that we're going to get a blow up in oil, and therefore I see no danger from DBC in the next couple of weeks. Okay, so what does all that mean for equities? Well, it means that times 18 is probably too expensive and times 16 is probably too cheap. I don't think that what Powell said on Friday is especially bearish equities. It's bullish term premium, which depresses equities, but I don't think it's signaling another leg lower in the equity complex. I'll explain that a little bit better later. You've got this chart. I don't think it's going to go through time 16. What is the danger, though? The danger, though, is that we get a further leg down in the earnings expectations, and then the positioning of the time 16 is going to be slightly lower. But what I'm really saying is that if you new lows would be a buy either way. Because you will get this kind of trading up and down, up and down. So Powell was not bearish equities. He was bullish this chart here, term premium. Now we haven't had this updated since the 19th. It'll be up here. To me, term premium will rise. What does that mean? That means that people will be buyers of bonds over equities. And that is why equities are unlikely to rally rather than go down outright. There's a big difference between going down and not rallying. So my message is to sell slightly in the money calls for 1 month. And if we look at the risk spreads, this is what I mean by term premium. This is SPY over TLT. complete rejection of going higher, we should come back down to around this kind of area, 340s. So that's another 3-4% lower, assuming that the long bond does nothing, like I think it probably will. You're talking 5%, something like that in equities, lower, worth having. But probably what it means is that as volatility rises, as the market comes down, you want to be short in the money calls, rather than and let theta do the work for you, and in 2 weeks' time they'll expire worthless. So that is more or less what you're looking at. The interesting thing to me is now this, because you could easily get one of these kind of spikes in SPY, XLY. The narrative being like this. So you have the housing market going for a Burton. You have you have people's electricity bills, gas bills, whatever, being higher. They're maxing out their credit cards. They're gonna stop buying stuff, and XLY gets hit. So you can see how XLY, SPY really, even on Friday, didn't break out. To me, the danger is that it breaks out and it goes to these kind of levels in a big hurry. And that's a move from 255 to 265. So that's 5%. So I would much rather sell XLY than sell SPX. I want to show you this monthly chart because we're about to close the monthly candle this week, and the market is actually going to it's going to be absolutely critical whether we close it below 41.81 or not. This would have been a complete head fake, as I thought it might well be. Closing below 41.81 keeps the pressure on for returns down to here, but this is what this Bollinger Band on the monthlies, which is very powerful. You hardly ever, and in 40 years, hardly ever close below the monthly Bollinger Band. So you can see that all these levels here around, what is that, 3,700-ish, are going to be very, very good bounce levels, and you could easily get this kind of behavior for the next 3-4 months. So to me, this is not particularly equity bearish, as it is you're not going up, mate. So what kind of level would it be sensible for the market to return to, given that you have something like I showed you SPY, TLT coming back down, the percentages that would involve? Well, that tells me a return to these kind of levels between 38.61 and 39.43 is eminently sensible. And if we look at a daily chart, where will that be? Right here, you can see that we are 39.83 is eminently sensible. The fact that we broke so decisively below that 41.29 level that I had as so important tells me that any kind of bounce up to it will get sold, and we will have something like this and bounce off the 39.83. That is why I'm not really bearish equities. I'm more bearish their ability to rise, and I'm and I'm more bearish the internal components like XLY, because if I'm right and interest rates do what they're going to do, the pressure is really not going to, and if 30s don't move, or they do even slightly better, why should NDX completely fall apart? And only if NDX and the tech sector completely falls apart, then you're going to get a big violent move in SPX. I think it's much more likely to be XLY, as I showed you, that is in trouble rather than the overall market. Here you have NDX over INX. I can even enlarge this area here. Has it really done very much? Here you have a 200-week moving average coming in as support. And as you can see, basically this level is very, very, very important. I don't see it being broken in the next 2 or 3 weeks. I really don't. For duration would have to do something very, very unusual. And the 30s would have to go and break that very important 324 level for this kind of chart to start falling apart. That is why I keep on saying that unless the 30s really start breaking, and I can actually go very quickly to this chart of 30s again, the level is 345. Unless 30s break 345, I just can't see this chart breaking these lows, and then the equity markets, all the indices would break apart. But unless that happens, and I can't see it happening, because I think it's a question of term premium going up, and therefore people buying bonds and selling equities. That's much more likely to happen. And therefore, if I put all that together and then have a look at an NDX chart, well, that tells me that we are much more likely to come and trade just below 12,000, in this 11,700 area, and possibly 11,846 to 11,566. And that is all we get, as opposed to new lows. I just can't see new lows at the moment. I just can't see the reason for it. What did Powell tell us? Powell told us that the 30s are priced right. What could be priced wrong is maybe the 2s and maybe the 5s and maybe the 10s at a push. But the 30s are priced right. And in that case, I really can't see NDX really taking it on the chin. A couple of percent, sure, but not that much. And the other reason why I can't just sort of sell equities and go away, I can sell calls and stuff like that, and call spreads, etc., 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 is the Nikkei. What's it doing? It's just correcting very nicely. It's just not looking all that bearish. It held 28,180 on the close. Okay, it can probably come down a little bit. Can it trade down to 26,940, 26,910? Great, if it does, it's a buy for a bounce. So that to me ties in with those levels being reached in the SPX that I showed you, but not a complete massacre by any stretch of the imagination. I don't know what to make of European equities because, as I've been telling you, the danger is not so much for private corporations, but that the government does something silly, like say that they're going to take the whole of the energy burden onto themselves this winter and balloon the deficit. If they do that, they're actually helping corporations, aren't they? So it's not the European stocks that are going to take it on the chin, but it's going to be the European bonds. To me, this 33.83 level is absolutely key. And I think it's actually unlikely to be broken because the balance of risks is on the bonds rather than on the equities. And therefore, I'm not going to sell equities. I would much rather have calls at 33.83 and have puts, or put spreads or anything else where I'm long of volatility in the bonds in the EU. I just have this feeling that it's going to be A, the currency, and B, the bonds that take the strain. And let's face it, if the currency falls another 10%, as I showed you, why would people sell European equities necessarily? It just makes them cheaper and cheaper and cheaper. And the war at some stage will end, and at some stage the currency will appreciate, and. So I don't think it's going to be equities that really take it on the chin. I think it's going to be the European bonds. VIX to me is saying that the market will go lower and volatility will go higher, but it's not going to be that much, and it's going to be a brief period. So if you have a look at the way the market has behaved, it's always had a couple of weeks or even 3 weeks of going up towards 30 and then spending most of the time of going, the 4 or 5 weeks going back down and retesting levels. We have this gap now, weekly and daily gap. And so that in 2, 3, 4 weeks' time, we're going to have the pressure going back down towards there. That to me says sell in the money calls for the next couple of weeks. Expiry in just before the Fed, that kind of a thing. Something around the 15th of September, 15th, 20th September expiry, because the market is likely to be slightly lower than it is at the moment, but it's not going to be a million miles away. Here we are. I've updated all the levels. To me, these are the dangers. These are the dangers. If you start seeing this move, know that the shit show is starting. Great. This is all I'll be watching next week, because I think that is more important than anything else. Have a wonderful Sunday, and I will tweet you tomorrow.